We need to accept the fact that airlines are transforming into financial powerhouses. It may sound weird, but it's true. There's a surprising paradigm shift beyond the clouds, where airlines are no longer just about transporting passengers. Dive into the fascinating world of loyalty programs, which transform carriers into financial behemoths, challenging the fundamental foundation of the industry. Fasten your seatbelts for an enthralling journey over the skies transformed into banking boardrooms. Last year, the financial details of airline frequent flyer programs were revealed in an unprecedented manner, unraveling an unexpected narrative. Airlines needed loans for survival as the COVID-19 epidemic inflicted financial damage. Notably, United sought a $5 billion lifeline, a difficult idea given the airline's declining value throughout the crisis. In the face of the demand for collateral, United cleverly presented Mileage Plus Holdings, LLC, essentially its reward program, as security. When United's loyalty program was valued at a stunning $21.9 billion, this move got even more fascinating. Delta and American Airlines disclosed similar financial disclosures, valuing their loyalty programs at $26 billion and $31.5 billion, respectively. What made these figures noteworthy was their comparison to the market capitalizations of the airlines themselves. United's market capitalization was $10 billion, Delta's was $20 billion, and America's was $6 billion, all of which trailed the value of their loyalty programs. This result prompted a shocking conclusion on Wall Street. Airlines were not only worth less than their loyalty programs, but were also judged worthless. Due to financial difficulties, many airlines' only marketable asset was their loyalty programs. This concept, while ridiculous, gains credence when one considers that, even before the pandemic, American Airlines made significant profits from their frequent flyer program, demonstrating the growing importance of similar programs in the aviation business. The airline industry's dynamics have changed dramatically, changing airlines into companies that, ironically, lose money in operations but survive as financial behemoths due to their lucrative frequent flyer programs. With the liberalization of the American airline industry in 1978, frequent flyer programs, which were initially similar to loyalty punch cards, became formally and legally practicable. Airlines have effectively evolved into banks, willing to bear losses in their transportation operations to sustain their frequent flyer programs. The finely crafted flying experience, enticing customers to sign up for credit cards and frequent flyer programs, exemplifies this paradigm shift. Once purely for transportation, flying has evolved into a determined tactic by airlines to boost their financial empires through the appeal of cheap flights and loyalty rewards. Well now, investigate the fascinating journey of airline loyalty programs from humble beginnings to financial behemoths. Witness the revolutionary influence of customer loyalty, beginning with Texas International and then soaring with American Airlines in 1981. Passengers who were lured by free flights voluntarily spent extra money to fly with their favorite airline. As the program grew, collaborating with Hertz and Holland America, a game-changing change occurred: the inclusion of earning points with third-party partners. Discover the clever mechanisms behind this transition and the resulting soaring profitability. Co-branded credit cards were introduced in 1987, and they significantly increased the earning potential of these loyalty programs. Discover the incredible way in which airlines transformed loyalty points into profitable business centers, breaking traditional taxation principles. Join us as we tell the enthralling story of how airlines gradually grew into financial behemoths, altering the sky and the very essence of air travel. The corporation paying does not have an issue with this because it essentially works as a tax-free perk for their employees. Companies are happy to allow their employees to earn points that can eventually be used for leisure travel in exchange for them getting out on the road and making money. Of course, this potentially creates a scenario in which the individual is incentivized to travel, fly, or pay more at the company's expense, but most don't appear to mind, thus both tax law and company policy, or lack thereof, work in the airline's favor. The way frequent flyer programs were set up wasn't perfect, but there was room for abuse. Meanwhile, based on the traditional 1 mile 1 point method, despite the price difference, the member would only receive 400 points for each of those flights. If a traveler found a low-cost but long-distance itinerary, their mileage earning could be so high that the miles earned were worth more than the cost of the flights. They were incentivizing people to take longer multi-stop itineraries, which cost the airline more to operate, and it forced them to give out more miles, which cost the airline more in redemptions. In short, they were incentivizing against their interests. United Airlines. It's simple. For every $1 spent, you receive 5 points. This changed the system from one in which the airline wins overall but may lose money from time to time, to one in which the airline cannot lose money at all. Revenue-based systems cannot be manipulated, but airlines quickly figured out how to rearrange the redemption side in their favor as well. For example, on United, any economy class travel within the continental United States used to cost 12,500 points, regardless of whether it was a Tuesday or not. Even though cash rates were undoubtedly far higher on the Sunday after Thanksgiving, one of the highest demand travel days of the year, availability of point seats differed, which meant that someone who did manage to score a Thanksgiving Sunday booking on points got a deal because the cost for the airline to offer that seat on points was greater than what the airline earned. Even if everything worked out in the end in the airline's favor, they didn't like the losses, so they changed the way redemptions work now. Nearly every major airline has dynamic award charts, just like how cash fares rise for high-demand days, so do point redemption rates. For example, in October 2022, United is charging $114 for non-stop Newark to Denver flights on low-demand Tuesdays and $254 on high-demand Sundays. Because mile rates are now correlated to cash rates, arbitrage between what airlines charge in miles and cash is no longer possible. So they've now closed loopholes on both ends of the equation. You can't exploit the accumulation of miles or the redemption of miles. Given how much of their earnings comes from selling points to credit card companies, the exchange rate is virtually the sole element limiting airlines' dominance. As well as other marketing partners, airlines care a lot about how much companies are willing to pay for points, and how much companies are willing to pay is loosely based on what the general public believes those points are worth. Various travel and finance websites publish their estimated point valuations to help consumers determine whether they're getting a good deal with a given redemption, and there is a lot of variability. The average value of 1 point based on 5 estimates is 1.2 EU, 118 cents. Delta Sky Miles, 1.2226. United Mileage, plus 1.416. American Advantage, 1.416. What this means is that, if everything else is equal, consumers would be more incentivized to fly American, use American co-branded credit cards, transfer points to American, and more, which means credit card companies and other marketing partners will run out of American points sooner and will need to buy more. However, power remains in the hands of airlines because there are only 3 major long-haul airlines in the United States, but far more credit card companies. United has partnered with Chase American, with Citibank, and Delta with American Express. But if any of these credit card companies refuse to agree to a higher mile purchase price when contract negotiations came around, the airline could dump them and switch to Bank of America, Barclay, Capital One, Discover, each of which would be delighted to score a major airline partner. So why is it that the value of these frequent flyer programs has eclipsed the value of the airline itself? That airlines are essentially acting as the central banks for their virtual currencies, acting like the United States Treasury, the Bank of England, or the European Central Bank, controls the supply of their currency, but airline power goes far beyond that of these central banks. Not only do they control the flow of the currency, but they also control the availability of goods to spend it on. And on top of that, it's as if these all-powerful central banks are acting as if they are make more of their currency to sell it at any moment. Airlines have practically total unregulated control over a currency in which they are the only entity capable of converting it to cash, which is the key to their power. Frequent flyer programs are brilliant financial tools since they are practically impossible for airlines to lose. Think about all the times in your day when you are not using your ears, such as when you get ready for the day, cook dinner, do laundry, or drive to work. Travel over the sky on a spectacular tour where loyalty programs converted airlines into financial behemoths. Witness the enthralling transformation from sandwich punch cards to multi-billion-dollar profit centers. The skies are no longer merely for flying. They're also a blank canvas for financial innovation. If you like this video, make sure to hit the subscribe button. Until next time.